Money Sense, bringing an informed financial perspective to the Cayman community.
Good morning and welcome to Money Sense. I'm your host, Neville Hicks, alongside Christophe Barnett.
Good morning.
And just before we introduce our special guests, I wanted to just kind of reiterate that the CFA Investment Forum is taking place next Thursday. That's October 13th. This is kind of the CFA Society's marquee event, and we really encourage all of our listeners to check out the website, www.caymaninvestmentforum.com. You can register there. This is a half-day event. We've got 5 incredible speakers coming down here on island, so it'll be extremely informative, especially kind of given what's going on in the world today. And joining us this morning, live from California, is one of the speakers, Mebane Faber. So welcome, Meb.
Hey, great to be here. Thanks for having me.
Yeah, thank you for joining us. I guess just a little bit of, I'll just briefly introduce Meb. He's got quite a resume, and then we can kind of jump right into a lot of the stuff that, will be discussed next week, and it certainly will be an interesting to have him here live with us in anticipation of the investment forum next week. But in any event, Meb is the co-founder and chief investment officer of Cambria Investment Management. Meb is manager of Cambria's ETF, separate accounts, private investment funds. Meb has authored numerous white papers, 5 books, and is a frequent speaker, writer, and investment strategist. He's been featured on New York Times, New Yorker. He graduated from the University of Virginia with a double major in engineering science and biology. So we're extremely lucky to have Meb join us here today. So thank you again.
Yeah, absolutely. It's going to be fun.
Kind of jumping into it, I know your strategies, your investment strategies through ETFs are mainly on the quantitative side. For our listeners out there who maybe don't know exactly what kind of quantitative investing is, I think it'd be helpful if you could kind of give just a bit of an overview as to how that shapes and kind of how you look at different asset classes.
Yeah, the easiest way to think about quant investing is that it's rules-based, meaning you have rules based on to buy the security or investment strategy and rules to sell it. And the most famous example, of course, is something like U.S. stocks through the S&P 500. So you're getting roughly exposure to the 500 largest companies in the United States. It has rebalancing rules, et cetera, et cetera. Now, that doesn't mean that the quantitative system is a good system. A quant system could be something like, does the CEO wear a tie or a bow tie?
Right.
Or does the CEO drive a red or a black car? That is a quantitative system. So what you've seen is a proliferation of a lot of quantitative rules-based ideas that aren't great, and some that are great as well. So there's quite a large spectrum of kind of saying quantitative is kind of like saying dog. A Dachshund looks nothing like a Great Dane, which looks nothing like a Bulldog, but they all share the same characteristic, and that's being rules-based methodology.
So some of the audience might hear you and think, well, doesn't everyone consider rules when they make investments? Like, I guess what would not be a quantitative investor?
Well, it's actually the way most people invest. Most people invest kind of seat of their pants. They may be watching CNBC, not listening to this radio show of course. But here's a good example. So going back to the 1980s, there's a sentiment survey where they ask individuals in the U.S., the American Association of Individual Investors, they say, are you bullish on stocks, are you bearish, or are you neutral? And there's a pretty wide range of responses going back 30-plus years. And what they found is that the people were most bullish on stocks I think it was December 1999, literally the worst month in the entire history of the sample to be bullish on stocks. Then you can probably guess the opposite. When were people most bearish on stocks? They were most bearish on stocks March of 2009. Literally the single worst month, the best buying opportunity, people hated stocks the most, and that's because we're human. We've evolved to run away from the lion on the savannah. We're not adapted to risk in the current form of financial markets, and so most people don't have a plan. And a great way to do it is simply to write it down for your investing approach, for your style, for even how you pick your investments. We think it's not just important; we think it's crucial.
So almost to protect people from themselves in a way.
And it's hard. Look, I mean, we're all human, and there's been so many great books written on behavioral biases, and I have them all. I mean, I'm overconfident. I'll take as much risk if you can give it to me. But the important thing is to at least learn to be a little self-aware and say, okay, look, I have these things. I have these biases that are going to work against me, so let me come up with an investing plan. It's kind of like being a quarterback. You know, I'm a Broncos fan, so if you were Peyton Manning coming to the line of scrimmage, he looks at the defense and he has a plan for every possible scenario. And that's what having a written investment plan is like, because, you know, if interest rates go from 1.5 to 10, or if they go from 1.5 to -2, or if the stock market doubles, or if the stock market goes down 80%, you need a contingency plan for all those events. And most people don't do that. Most people simply, you know, have a portfolio and things go crazy. You know, they adapt to it, and usually much to their detriment.
So earlier you described a quantitative strategy where we own the top 500 stocks in the U.S. And if people didn't quite catch that, that's the S&P 500, and that's can be accessed through various index mutual funds or exchange traded funds. And I think people might be surprised that it is just a quant strategy of owning those top ones, but that's typically what we mean when we say buy and hold or invest in the U.S. market. That's the exposure. But what are some of the, and we mentioned the tie strategy too, but ignoring that one, or the red car, but what are some other quant strategies that make a little bit more sense than the red tie, but maybe aren't as simple as buying the top 500 stocks?
I actually think the red tie would be a great strategy, but we'll probably stand upon
Overconfidence.
That later. Well, look, and one of the reasons is that the S&P 500 is an example of a strategy that, because it overweights, it puts the biggest weight on the biggest companies, it often overweights the most expensive. So a good way to get around that, so the red tie example would be that if you equal weighted 500 companies, but one of the most famous, of course, that people are very familiar with is the value investing style. So a Warren Buffett investing style, and the most classic one that's familiar to investors is something as easy as investing in high dividend stocks. And traditionally, that's given you a value tilt, so that will outperform a basic S&P 500 stock allocation by maybe 1% or 2% per year. Now, the challenge with any active strategy, and that's, you know, anything that deviates from just kind of the what we call market cap, buying the entire world sort of strategy like the S&P, anything that deviates is active. So those active strategies can go not only years, but decades underperforming the traditional market, the broad market. And a lot of people don't have the constitution to wait that out. And we saw a survey recently that said 99% of people would fire a manager if he underperformed for 2 years in a row. But even Warren Buffett, one of the most successful investors ever, you know, has had plenty of periods of many multiple years underperformance. So it's a really hard thing to be different. It's particularly when you're being different and looking worse. It's easy to be different when you're outperforming.
Certainly.
But when you're underperforming, it's hard to stick to that type of strategy. So this dividend is an example of one. We actually think it's something people should be running away from right now. But in general, it's been a great strategy for over 100 years.
So just touching on your point about the managers getting fired, then it seems that discipline is a key component of quantitative investment, because if you have a strategy that historically outperforms, but you don't have the discipline to follow it, then you're back to the sentiment example you were talking about, right? It's almost like sentiment of the strategy.
Easy to say, hard to do. You know, that's the challenge. Even in the institutional world, you know, so we talk a lot to individual investors, but also to big institutions. And the big institutions behave just as poorly as the individuals do. They use often quite a bit more sophisticated language, but they end up making the same bad decisions, where there's a lot of academic research to support this, where they'll fire managers that have been underperforming, hire managers that have been outperforming. And, of course, as soon as they do that, what happens? while the underperforming managers
Outperform.
revert to good performance, and the ones they hired do poorly. So it happens over and over, and it's very hard to commit to a style. The Buffett example we gave, we said, look, if you just went in and bought the stocks that Buffett bought, updated it once a quarter, so this takes 5 minutes per quarter, update it once a quarter, sat on that. He doesn't trade much, so there's not a lot of turnover. And you looked at how that would have done since 2000, that basic strategy would have outperformed the S&P 500 by about 5 percentage points per year. So monster outperformance. It would have beaten 98% of all mutual funds.
Right.
However, that strategy would have underperformed the market 8 of the last 10 years. And so how many people could sit through that? So very few. Forget 1 or 2 down years. Underperforming 8 out of the last 10, no manager on the planet would still have a job. And then that's one of the reasons we say Buffett's alpha, one of the reasons he's done so well over the decades is not because he has a magical investing strategy. Value investing is actually pretty simple, but rather it's because he's stuck to his strategy. And so he can sit out these periods of 1, 3, 5 years, 10 years of underperformance because he knows that it's cyclical. But most investors can't. So whether not just individuals, most institutions can't either. So a way to do that, of course, is to be quantitative. But really, you still have to have the constitution to say, look, I'm in this for the long view, and that's a really hard thing to do.
And I guess just touching on time and time periods, I think with any investment strategy, or whether it's quant, value, to your point, even Warren Buffett, 5 of the last 8 years has underperformed the general market. What do you tell your investors with time frame? And you see those people who make an investment and they're frantically ripping open the envelope monthly to check kind of what they're making. What's the kind of message you give from more of a quantitative strategy?
It's hard, and the best that we can try to do is educate investors. And this is one reason a lot of people want to have a financial advisor or some sort of automated solution so that they take their hands off the steering wheel, or at least they have someone in between them and doing something really dumb. That doesn't mean that it's going to stop people, because people can, still do whatever they want. But that's one. It's the same sort of nudge you would have with any other avenue in life. If you wanted to lose weight, you might not buy a lot of, high calorie food and put it in your fridge, because that would make it easy to do. And so the same thing if you had maybe a partner or a husband or a friend that says, hey, I'm going to check in on you every week and to make sure that you're following this diet or exercise regimen, that makes it a little more accountable. And so having an advisor or having some sort of, intermediary to keep you from, lighting the fuse is certainly helpful, but it's still hard. And so right now if you look at the Dow, we're in the 3rd longest bull market ever in the U.S.
Certainly.
If it makes it through December in the election, will be the 2nd longest bull market ever. And if it makes it all the way through the spring, we'll have the longest bull market of all time. And so this is an environment where for the last 7 years we've had great returns. At some point, we'll have a bear market again. Don't know when, but it's a guarantee. So it's preparing for the bad times before they come is tough. But again, it's crucial.
Certainly. We're going to take just a short commercial break, but when we come back, I think we'll touch a little bit more on the active and passive debate, which I think there's some good points for people here. So let's just take a quick break, and please join us again after the break.
This is
Money Sense, bringing an informed financial perspective to the Cayman community. Brought to you by the CFA Society Cayman Islands and sponsored by One Trade X.
And now, more Money Sense.
Welcome back to Money Sense. I'm your host, Neville Hicks, alongside Christophe Barnett. We're joined here by Mev Faber, who's joining us from live from LA. So thanks again, Mev, for taking the time and joining us this morning.
Yeah, of course.
And Meb will actually be down here for the 4th annual CFA Investment Forum next week, October 13th. So if you're interested in hearing more about what Meb has to say, please join us. And you can check that out at www.caymaninvestmentforum.com. We're just picking up, talking about kind of a passive versus active strategy. And, maybe Christophe, can you just break it down what that means exactly for the audience?
Well, unfortunately, some of these definitions get kind of muddled, and maybe you could probably add to this. But essentially, a passive strategy is where instead of making any decisions to buy more of one security or investment, and by definition having less of another one, it means that you just look at all of the assets that are available, let's say in the stock market, and investing your money according to the size of the investment. And an active strategy would say, well, no, we're not just going to invest based on all of the securities in the portfolio, but we're going to maybe we have a value strategy, and so we're going to overweight value investments, and therefore underweight the so-called higher value investments, seeking to achieve a return, or even weighting your investments equally rather than by market weight. So that would be an active strategy.
Certainly.
Yeah, it's kind of gotten muddled over the years, of course. I mean, I think you touched perfectly on the original description of active and passive. I mean, passive traditionally has meant just buying the largest companies, weighting them by size, and doing nothing, updating it once a quarter or once a year or whatever. Low turnover, and that's a good first strategy. We think it's not ideal for a lot of reasons. So any deviation from that traditionally is seen as active. So whether you have some guy like Peter Lynch or Warren Buffett who is out picking stocks, or whether you have a quantitative algorithm that's doing it, any of those are deviating from that what we call market cap weighted portfolio. And we think there are some very sensible ways to do it, and then some, of course, not so sensible ways to do it. But in most cases, either approach can work. Particularly as long as you charge, don't pay too much in fees.
Certainly, and I think just adding, obviously Cayman itself is, a huge hedge fund domicile. There's quite a few people here who are involved in that space, which would certainly fall into more the active category. And there's been kind of, I guess, what you would characterize as a huge kind of boom in this active space or hedge fund space, over the last 20, 30 years. But it does seem that passive or more indexing strategies have certainly gained some more momentum over the last kind of 5 to 10 years. Would you not say, Meb?
Yeah, and there's the water has again been slightly muddled. So we actually manage both active and passive strategies. It's a distinction that is kind of lost on us because everything we do is rules based. And so, when you're talking about hedge funds, it's also murky as well. What the hedge funds look like in the 70s and 80s with the long, short equity guys or the macro funds or the, old school type of funds. There's now hedge funds that look completely like the S&P 500. And then there's also passive strategies that look like hedge funds now. So the world has gotten a lot more, kind of interconnected, and the definitions have gotten a little muddled. But the whole takeaway for us is very simple, is that if you're looking for what we call beta, which is just broad exposure to an asset class like bonds or stocks or real estate or commodities, the good news now is it's an amazing time to be an investor. You can get exposure to those for very low cost. In many cases, less than 0.5%. In some cases, less than 0.1% per year management fee through various funds and ETFs. We manage a handful of them. And then second, if you're going to go look for outperformance, so whether that's in mutual funds or hedge funds or any active strategy, you can then go look for that elsewhere. Traditionally, that costs a little more, but in general, there has been fee compression all over. And all that matters, of course, after everything is said and done, is your total return after all the fees you pay,
Certainly.
Not just, of course, management fees, but also commissions and taxes as well.
Certainly.
So, Meb, one of the things you cover in your blog is forward return expectations. So, if I'm invested in stock, what should I expect? Or bonds, what should I expect? Or even real estate and some of the alternatives. So, we're coming, I would say we're coming to the end of the bond bull market, but I guess we can always go more negative with interest rates. But let's just say we've had a huge run in bonds since the 80s. And we've seen a huge run in stocks since the last two 50% declines, and so we are at high valuations. So what does that mean going forward in terms of the quant strategies? When we look back in history, they sort of had different starting points. So sort of where are we now, and how does the starting point matter in a quant strategy?
I mean, no matter one of the biggest challenges in quant strategies, of course, is drawing too many conclusions from a limited data set or not enough history. And that's many of us are very guilty of that, where we kind of data mine the past to see what happens and may extrapolate in the future. So when we think about being quant, we like to take a step back and say, 10,000-foot view, is this something that works? And is it something I can explain to my niece or nephew? And is it something that's simple that has a fundamental reason why it would work? And so there's one of the biggest ones. One of the most kind of general laws of investing is what we call mean reversion. So when things have done very poorly for a long time, so if you think about stocks, when you've had a long bear market and you're down 50%, or think the Great Depression in the U.S. where you're down 80%, and vice versa, if you've had an amazing run like the 90s in stocks in the U.S., or now, after you've had many years of positive returns, usually the good times come right before the bad times and vice versa. And so one of the best things you can do is have what we call a fundamental anchor. And so you can look at, say, valuations for U.S. stocks and come up with historical. You can take this back. Professor Schiller has taken this all the way back to the 1800s. You can take a look at what valuations for the market were and how the market does going forward. And it's not rocket science, but the less you pay for something, so we look at historical 10-year PE ratios, so very long-term time horizon, which historically they've been around 17, but they've been as low as 5 in the U.S., and they've been as high as 45 in the internet bubble in the late 90s. And the less you pay for something, so when you have low PE ratios, future returns are much higher. And when you have very high PE ratios, future returns are much lower. And so where we are right now, we're sitting at a long-term PE ratio of around 26.
This
is
for the
high,
U.S.,
but
right?
it's not a bubble. It's not as bad as it was in the late 90s. So all that means is future expected returns should be lower. So we think around 4 percentage points in the U.S. That's positive. It's higher than the 1.67% you get with bonds, but it's also not the historical 9-10% people expect. So there's some takeaways of that, of course. One is just lower your expectations. You accept the lower returns. Or two, think about being a little more conservative. And lastly, the good news is most of the rest of the world's stock markets are much cheaper. So most of the world is normally priced quite cheap. A lot of the emerging market countries are very cheap. We did an article at the beginning of the year called, the cheapest stock market in the world, and they're the Brazils and Russias of the world. And certainly a lot of Europe. Europe has really struggled since the global financial crisis. So there's good news, bad news. Bad news is U.S. assets, expected low returns. Good news is most of the rest of the world is pretty cheap.
Right. And I think just touching on that a bit, I mean, as far as you did speak about it earlier, just about fees, and we always look at kind of what fees are and access to different products now. What's kind of one of the single biggest things? I mean, we always look at fees being kind of one of the single biggest things that kind of investors can control. What are you seeing in the markets as far as access to cost-effective investment strategies versus, let's say, 5 years ago?
You can access many ETFs or what they call robo-advisors in the U.S. for very low cost. Many of them are 0.2, 0.3%. There's even a handful of 0% ones. So we just launched one, charges 0% fee. We have an ETF that has a permanent 0% fee. Both of them own some underlying funds, but in general, the costs are coming down for many of the allocations, which is a wonderful thing. And we did a a recent book called Global Asset Allocation. And if your readers want to go download a free copy, they're welcome to. They can go to freebook.mebfaber.com, download a free copy of this book, or you can pay $3 on Amazon, and it's not that much more expensive. Well, it's a really fun thought experiment where we looked at a lot of the most famous asset allocation models in the world, so proposed by David Swinson of Yale, or even Warren Buffett himself, and Mohammed El-Arian, who used to run PIMCO. And we looked at 15 of these famous allocations where they said publicly, here's how an individual investor should invest, this much in stocks, this much in gold, this much in bonds. And we showed how that would have performed all the way back to 1973. And the really big interesting takeaway was, with the exception of one portfolio, which was half in cash and bonds, so very low volatility, all the rest of the portfolios over that entire period performed within 1 percentage point return of each other. So if you think about, you would think that some have 25% in gold, some have zero, some have a ton in stocks, some have very little. These vastly different portfolios had very similar performance. But one of the big takeaways was that if you then layered on the fees, so the average mutual fund is about 1.25% in the U.S., the average financial advisor is another percent. If you layered on traditional fees to implement these, even if you had a crystal ball and went back to 1973 and I let you pick the best allocation, which was an endowment-style model, and fast-forwarded, but you implemented that through the average mutual fund, you would have taken the best allocation performance and made it almost as bad as the worst.
Okay, wow. So that's
what
the
a lot
impact.
of people focus on, which is, wringing their hands every night of how much should I put in bonds, and what's going on with Brexit, is he going to affect my investments, all these things. The boring blocking and tackling for how much you pay for things through fees and commissions can have a much more important outcome than simply the allocation itself. And I think that's a pretty profound insight. Not that sexy. It's not going to win any awards at cocktail hour, but something that we think is a very important takeaway.
Certainly, and I think that's a great kind of note to wrap up on for our listeners. Obviously, probably one of the single biggest things that you can control as an investor is how much you're paying your advisor, or understanding the different layers of fees within the financial strategy that you're investing in. We're unfortunately we're out of time. That flies by as it always does. But Meb, really on behalf of the CFA Society, myself and Christoph here, we're absolutely thrilled that you could join us all the way from LA on the phone. And we're obviously really excited to get you down here in Cayman next week.
It was a lot of fun and looking forward to it.
Okay, great. And just for our listening audience, wrapping up again, I know I've mentioned it a couple times, but it's fast approaching the CFA Cayman Investment Forum, 4th annual, next Thursday, October 13th. Check out the website, CaymanInvestmentForum.com, and we really hope to see you there, and hopefully you can pick up a couple more tips from Meb. Until next time, have a great day, and we look forward to speaking with you guys in 2 weeks.